Hi, class. Welcome back to week 11. Today we'll be talking about the week 11 chapter, but I just wanted to make some announcement before we started. Next week there would be no chapter. There would be a multiple choice test. So you just need to open as usual, at the same time of your class lunches. You open it and you write your test. It will be 20 questions, multiple choices, and I will be using the Google Classroom. Let me know if you have any question. Thank you very much. So let's start with the chapter 11. The test will be covering from chapter 1 to 11 to whatever we are taking today. So we'll start with chapter 11 today. So your test will be on the week 12, which is chapter up to chapter 11. Now, today we will be talking about the compensation. In the compensation, what we will be doing is basically we'll be talking about the pay and incentive system. And here where we do that, we will help the HR manager to answer a few questions. The questions are, how can we tie the compensation to a strategy, to general business strategy? So how we can tie the compensation strategy to general business strategy? What economics and legal factor should we consider establishing the pay levels for the different jobs? What is the best way to develop pay systems that are understandable, workable, acceptable to all employees at all levels? How can we tie the incentive to individual, to team, or organization performance? Implementing a pay per performance system, what key traps must we avoid to make the system work as planned? So the four key challenges in the planning and administrating a pay system is the fact first we need to understand the economic and the legal factor that determines the pay level. The situation, the economic situation, the jobs, or whether it's a high demand, low demand, supplies is available, the whole economic, we need to understand that. Then we need to tie the compensation strategy to general business strategy and address the key policies issues and develop the systematic pay structure. Now, change in the company philosophies concerns pay and benefits. We'll be talking about these changes that is happening. There is an increased willingness we see that to reduce the size of the workforce. So they are cutting down on the workforce and more machineries. We see that outsourced jobs overseas, simple jobs at low level, will be outsourced overseas, and there is a strict pay to control the cost of wages, salaries, and benefit. They're less concerned with their pay position relative to that of competitors and more concerned with what the company can afford. So they care less about what the competitor is paying. They are more, companies are start looking at themselves saying, what can we afford of paying? And implementation of programs to encourage and reward performance. There is something to say about this. They're less concerned with the pay position relative to the competitors. I had my boss always says, you pay peanuts, you get monkeys. So you want to make sure that you get a people that you can build on and have them stay in with your organization. So if you pay peanuts, which is very low money, you get monkeys usually. But back to the subject, makes the pay more variable. That you don't need to reduce the whole pay. You just make the pays more variable and depend on the certain conditions. Now, in the organizational reward system, you need to include anything an employee values and desire that an employer is able and willing to offer in exchange of the employee contribution. So you want to see that what's the employee is willing to employer willing to pay and or share, and whether it's benefit for the workforce. So you want to put them in the compensation and then the reward and all these things. The compensation can be include both financial and non-financial reward. You need to see the financials and non-financial reward. These are the two things that can become combined together. Maybe you like to give a salary and extra health care, or a salary and a free trip to Caribbean, whatever. It's a part of the compensation, or a promotion. Also, it's a kind of part of the compensation, which is this non-financial reward. Should provide the following in order to be effective. In general, is you have to be sufficient level of reward to fulfill the basic need. You need to really give the person enough so he can survive and make a better of his life, because the things next things he will look somewhere else if he has an option. The equity with the external labor market and within the organization. So you want to make sure that the employee that you get is there is equities and not equality. Equities is like whatever he deserves, we should give to him, and you should compare it with the external market and within the organization itself, and the treatment of each member of the organization in terms of his or her individual need. Some people likes to see more promotion, some people likes to be more salary, some people like to see more compensation, incentive. It depends on how they see that. Now, the financial and non-financial components of organization rewards, it could be financial, as we said, when we could be non-financial. In the financials, such as direct payments, like salaries, and indirect payments, like benefit, health benefit, I don't know, the traveling. These are indirect payments. And non-financial is like a positive employer brand. You love to work for that company, you think it's a good company. Employee involvement in the decision making, effective supervision, recognitions, training opportunities, supportive things like nurturing in company's culture. These are things that you cannot put dollar sign on them, but the employee is looking for in these things and called the non-financial rewards. Now, the dimensions of equity in a pay system. So we said it's not equality, is equity. There is what you call internal equities. And the question that you need to answer in the term of the relative worth of individual jobs to an organization. Are pay rates fair? Are we paying fine to that job position? And then you have the external equities, or the wage paid by an organization, fair in the term of competitive market rates outside the organization. If it's not fair, we'll go back to the same thing. You pay peanuts, you get monkeys. And that's something I always remember, because he said that 20 years ago. Individual equities in each individual, is each individual pay fair relatively to that of the other individual doing the same or the similar job. So there is internal equities, there is external equities, and there is individual for each person. Now, The base for determining equitable payment, the common points in theories. Employee perceive a fair return for what they contribute to their job. So they see how much they contribute to the job. The employee should see a fair return. If they don't see that, they will cut down on their contributions or probably look for somewhere else. So the employees determined what their equitable return should be after comparing their input and outcomes with those of their peers or co-workers. They see their co-workers, their peers, what they are putting in work and what they're getting back. And if they see they're not equitable, then they might have a consequences. So better knowing what you call a social comparison, you compare with others. Employees who perceive themselves to be in an equitable situation will seek to reduce the inequities. So they see if they are in the disadvantaged situation, they will try to, seek to make it in the equity level, and may mentally distort their input or outcome. So they're putting less in, or they produce less, or directly alter their inputs or outcomes, or with the intention to do the level to do that, or leave the organization looking for a different organization. So the viewing the compensation from the strategic perspectives, f- firms action is in the compensation is recognized as a important, pivotal control and incentive mechanisms that can be used flexibly to by management to attain the business objective. So these are another extra tools help the managers to attain their business objective. The pay system is made an integral part of the strategy formulation. You or don't treat the pay system separate. You can utilize them into how to reach your strategy formulation. You probably need a high skilled person, you pay more. You need a low skilled person, you pay less. But it helps you, it depends on the strategy you want to reach. Pay considerations are integrated into the strategic decision making process, as we said, such as those that involve in a planning and controlling. So you need a high skilled person that can produce and very effective. You increase your salary, pay, and you see a good people applying for your job. Firm's performance is viewed as the ultimate criterion of the success of a strategic pay decision and operation compensation program. Now, to determine of a pay structure, how are we going to pay these people? I have employees, I want to pay them, how I will pay them, and at what level. These are issues that we need to take into consideration before we determine what we pay. So we look at the first thing, the labor market condition. Is there lots of condition? Is there lots of rules and restrictions or loose end? And you know it's a different from a country to a non-country. Whether there is a legislation, a laws governing that, and we don't want to break the laws. Whether there is a collective bargaining or what you call a union, which is affect the following key factors: the level of wages, and the behavior of workers in the relevant labor market. So if there is a union, which is we see lots of unions of hands in Canada, they are affecting the level of the salary. The salary becomes higher, and the behavior of worker in a relevant market, how that's happening. And what's the managerial attitude toward the employees, toward the pay? Should they pay high? And I said, if you're looking for monkeys, so you pay peanuts. And if you're looking for a good, high skill, and because you have a challenging task and job, then you pay better. So it's all your attitude, managerial attitudes toward the pay, an organization ability to pay. Now, once I like to pay my employees very well, but can I do it? Is my organization able to pay? If it's not, then it's not. But traditional job compensation moves to these stages. First, you look at the important job characteristic. What's the important? Why this job is important, and what's task that makes it important for the whole organization. Then look at the compensable factors in it. Their productions, how many units, all these things. You can look at what they can do. Then you do the job of evaluation to rate the relative worth of job. So this person, how much this job, anyone who owns this job, once you know it's produced 100, so you probably will see that it should be costing you, I don't know, from $10 to $50. It depends, you relate that. And then you see at what level it is, hierarchies, because these, once somebody is getting promoted, is expecting to get paid better. And the pay surveys to attach pay rates of the job to the job. You do your research, survey how much usually in the market this person gets with this qualification, how much gets paid. And you set up the pay structures to classify the job and grade level. We'll talk about the pay structures and how it's done and how much you put on the sale. For example, as a salary, how much you put compensation, how much you put as other benefits. These are all issues that get into involved in the pay structure. And then the assignment of individual pay within a range for each. So if you take the individual and says how much percentage of these works he's doing, so this is also affect the salaries. So first thing we do a job description, and the purpose of the job description is to identify important characteristic of each job, so that the relative worth of the job can be determined. We do a job to, identify the important, why this job important, and then you see whether it's worth how much you pay. Because if you cannot replace that person, and you're asking for to a very qualified person, once he moves out to better pay, it's very difficult to bring somebody. So these are very important. So job characteristic, identifying an important job characteristic of each job, help identify, define, and weight the compensable factors. The compensable factors, common job characteristic that an organization is willing to pay, how much is willing to pay, such as to certain for certain skills, for certain effort, certain responsibility, and working conditions. And these are issues that affect the salary. So if you're putting in, as I give you an example, if we were willing, we were paying $50 an hour for a entry level consultant in Kuwait. But when we wanted to move the consultant to Iraq, we start paying $100 an hour to the same person because we know it's not a very good condition there. But also we were nobody were coming, so we started giving $250 an hour for people, but we divided it in a risk allowance, pocket allowance, and basic salary of 50. But we added these, so once we move him back or move her back, it will lose all these things except the core, how much it worth. So this way we can keep the person also when he moves back. Now, in the job of evaluation, we provide provide a work-related and business-related relation, rational to support the decision about the pay. In other words, you will see this activities or things, how much is work that he has, how much is work related, and how much is to the business related, in order to help you to decide how much you should pay this individual. The objective is to rank jobs in the term of their relative worth to the organization so that an equitable rate of pay can be determined for you. Keep in mind, when you're paying somebody, it's cost. And besides that, you're paying that amount, you're paying the same amount for probably or some to the taxation, you're paying as income tax, you're also paying for other things like healthcare or insurance. An individual, when you hire, it doesn't cost you only, for example, when you're paying $50, is $50. So $50 probably add on 20, 30, $10 here and there for the job. So you need to calculate all these and see, is it worth to hire that person? Will he be producing more than that for the company? The different job evaluation method yield a different rank order of job. So therefore, different pay structure. So there is different way of doing evaluation. Now, whether you're doing a work related or a business related, and that will eventually drive your pay structures. And the pay structures is depend on how you evaluate this job. So if you have a work related, it's different than business related. It's depend on how you look at it. Now, there is a rule of thumbs. So jobs of same general value should be clustered into the same grade. So there is a certain value for these jobs. You cluster them all in one. It could be, the values a little bit fluctuating, but it's all in one cluster. Or you can do the job that clearly differ in a value be in a different pay grade. The other thing you say, well, this value for this job is more important. He's a night shift security guard, which is might run to more risk. So you value that more than daytime security guard, for example. Or you can pay grades from the confirmed reasonable well to pay pattern in a relevant of labor market. You check the market and see how much they pay, so you pay a reasonable at that amount. So these are the rules of the thumb. Now, the alternative way to pay system based on the job evaluation. So the job evaluation could be market-based pay system, as we said, or competency-based pay system. The market-based pay system is use a direct market pricing. How much is in the market this person is worth? Not this person, this job. How much the others is paying for this task. So you want to make sure you are in a competitive level. Then you do a feasible if all job be benchmark. If you can benchmark them, all these job, and then when somebody comes in, you see how much he's meeting the benchmark or he's an extra over that. So that's what makes it. Yeah, maybe. That's one of the ways of the education they do it is they benchmark certain salaries for certain course. But if somebody comes in who has better qualification, gets paid more. And then you got the competency based pay, which is workers are paid on the basis of their skills or on their depth of knowledge, both of which are termed competencies. So it's the more he knows, the better he gets. In such learning environment, usually the more worker learn, the more they learn. Uh, they earn. So their You see the workers will take courses to be certified in certain level, fly higher and higher because they want to get paid more for that also. Policies that you need in pay planning and administration that you need to evaluate, and you have to have them, is the policies in the pay secrecies, how secret should be one from one, how much they get paid. You need to look at the level of inflation. If it's very high, then you need to increase their salaries as meeting the information. You need to pay compressions. You want to make sure, if it's possible, you pay as low as possible. And if there is a pay raises, you want to pay on time. They're giving the raises for them. The requirement for effective system in general, you need to, as a program, has to be simple, not very complicated, very specific, very attainable, and measurable. So these are the issues that you need to take a look at them before you establish the system. Now, there is other ways we say why the merit-based system, but we will need to know why the merit-based systems may fail, the reason for it. There could be the rewards are too small. The merit-based pay fails to match the union pay scales. So there is a union pay scales and there is merit, but the merit fails to do that. The supervisor resists the performance appraisal, so he doesn't appraise the people on time, so they get better paid or lower. Links between the performance and reward is very weak. Some people get, notice that although they don't produce a lot, they get paid better, faster, and that might cause people not happy. And the annuity features create some problem why people getting paid higher, although they're not putting so much effort. But there is a guideline for the effective merit-based system that you need when you need to look at it is the fact that if you can establish a high standard of performance, you put a standard benchmarking for the performance, and then you develop an accurate performance appraisal system, and then you teach the supervisor how to use these, how to do the appraisals and the feedback, and then you link that reward closely to the performance and use a wide range of increases, different reasons. Now, the performance standards usually is to provide a relatively objective definition of the job. So you put the performance and you put a standard for us, indicators, units, and you put a benchmark, and then you count against it. You see how this person is producing against the benchmark, and there is a way of calculating it. And it gives the employee target to shoot it. So since it's clear, then it gives an employee target to shoot. So if he's producing 10 units extra, he might get a better pay. So he knows that, and he will do his best to beat that. And it make it easier for a supervisor to assign a work equity. There is another example. So if you have a salesperson, and if you're asking somebody to penetrate a new market, to sell in a new thing to a new person, that might be uh, should be more compensated than a market that repeatedly is done. So make it easier for the supervisor. It will make him to assign the work and makes it clear if he's, for example, if he's a sales supervisor, says if you get me a new account, you get a better compensation than the old ones. In setting up performance standards for production work, the ideal job should be, when it comes to the production, be highly repetitive, have a short job cycle, and produce a clear measurable. Highly repetitive, as we said, you produce, I don't know, 10 chocolate a day. So if you make it 12 chocolate a day, big chocolate, then it's the same job, repetitive. And if you make it more the unit measurable, then you get, a better performance, which is you connected to the better pay. Incentive system. Now you have a union attitude. And incentive systems set up by a unionized employers are subject to negotiation through collective bargaining. So the union usually represent the employees and they bargain with the employers to get a better salaries and is subject for the negotiation. Union may wish to participate in the day-to-day management of the incentive system, also, probably union attitude toward the incentive vary with the types of the incentive offered. So is all on a negotiation base between you employer and the union. Now, in the team incentive, is appropriate when a job is highly interrelated. So provide the opportunity for each team members in and receive a bonus based on the output of the team as a whole. So here is different. You're not looking at the individual, you're looking as a one team. And if this team produce more, you look at it as a one unit. And if they produce more, it's more better performance. Then you connect it to it. Or maybe they can lower the cost. You also connect to better payment. So the aim is to increase the productivity and improve the morale for the whole members, every members of one team. And the advantages is that make it possible to reward workers who provide essential service to the line workers and also encourage the cooperation and people are not competing with each other in the same team. They are helping each other to produce and create the cooperation. It's just like when you do your assignment, when it's in a group, you are helping each other to have a better assignment to get a better mark, something in that sense. Now, the disadvantage is the competition between teams. You might have your group competing with another group, and that's create the competitions because you're dividing the whole units to teams, and they might competing with each other. Or the inability of a worker to see their individual contribution to the output. And when you're working as a team, sometimes you look at somebody a weak chain, the weak thing, a person who cannot create the output. So this is why, for example, when you're working on your assignment, I said that you need to divide the type of the work, not the workload. See who's the strong in something, you give it to him. The top performers who grow disenchanted with having to carry free riders. So sometimes within one team, the top performance is not happy with the free riders, people who don't work. It's like you guys, when you're doing your assignment, some of them they don't respond or they don't work. So you're not happy with them. Now, the whole thing why I'm giving you a group assignment is to go through these activities. And tomorrow you will be working as a group, so in organization, so you will have the same thing, same feeling, how you're going to manage it. Now, there is another organization-wide incentive. Now, in this case, when we talked about a group, here what we talk about the whole organization incentive. There's something called a profit sharing. And the profit sharing is used in very advanced companies wherever they calculate end of the year how much profit they make and they share it with the employees according to his job level, how rigor is, how many years has been there. IBM does that. Some other companies do that. It's paid out if a firm meets the profitability target. And the reason to use that is to provide a group incentive to increase productivities So they feel one group and they will produce more productive, will produce better, maybe more cost effective, maybe more, more productive, put it this way. To provide a retirement income for employees because there's a profit sharing. So he has a share when he retire, he's still going to keep that share. Maybe to institute a flexible reward structure that reflect the company actual economic position. So it shows that how much the economic situation, are they making a good profit? So if they're making a good profit, they're getting better paid, and if they're making less profit, they're not getting. To enhance employee security and identification with the company, so he feels he's a member of that company, not an employee, and to attract and retain employee more easily. Once you're a profit sharing, says like 5 years you have to work, and then you will have a shares in the company. You will stick around for 5 years to get your share. To educate individual about the factor that underlying business success, what they understand, what makes this company more profitable, so they will be helping in meeting these strategies and goals. Now, the other thing is called gain sharing. So first one was a profit sharing, and here's the gain sharing. Is a result based on the program that links the pay to the performance at facility level. Compromise the following elements: is the philosophy of cooperation, involvement of the system, and financial bonus. And gain sharing could be working at the group level. Now, the difference between gain sharing versus the profit sharing, and the gain sharing is based on a measure of productivities, and the profit sharing is based on the global profitabilities. So, how much is productive here, and how much is a profitable here? And the frequent event, how many times they pay them, more frequent, distributed monthly could be, or quarterly every 3 months. But in the profit sharing, might annual measure on yearly, or every 5 years, whatever the annually. And it current distribution plan, but in the profit sharing is could be deferred later on. And this one might give you cash after 3 months. This one will be deferred for a year or 5 years or whatever. There is other options, which is employee stock ownership plan, which is you will own some stock of ownership. And here is you own the company, you not only share the profit. So in here, you establish for the following reason why you give that to the employees is as a means of tax favorite, because you will pay less tax because it's divided on the individuals. It's depend on the country's rules. Is, is company finance transfer of ownership from a departing owner to the firm employees? It then, so there is not one owner, is multi owners. It's a way of borrowing money relatively inexpensive, and when you are have a stock there, it's easy to borrow money and very inexpensive from the company or from outside because you own a stock. To and also to fulfill a philosophical belief in employee ownership. When you feel that you own part of that company, you do better. And as an additional employees, it looks at as additional employees benefit. So in this chapter, what we looked at the organizational reward system, how it worked. We looked at the compensation. We looked at the financial reward, the non-financial reward. We talked about the internal equity. What is the internal equity, external equity, individual equity? We differentiate between all these three. We looked at the balance, the compensable factors, how you pay people. We spoke about how you do a job evaluation before you attach some revenue, some pay to it, and the hierarchy of job worth. And we said that it's nice to have the benchmark job. We talked about the relevant labor market to look outside. We look at the board banding, the market-based system, how they do the competencies based pay. We look at how competent is the individual, so we pay based on that. We spoke about incentive, the merit system, and the annuity problem that we might face. We talked about the profit sharing, the gain sharing, and the employee stock ownership plan. So here, what we have done, we've finished with this part of it. So chapter 11. So the next week, you will have a test of 20 multiple choices questions. And would not be, there will be not chapter 12. You just go and open it and write your test. So I wish you a good luck, and I'll see you next class. Bye bye.